Are we live? Jeez. Cats have the zoomies right now. It's crazy. Hey, Momo. Oh my gosh. This is the moment he chooses to go wild. Is the sound working? I guess it is. Okay. It's taking a minute. All right. Well, let me know in the comments if everything sounds okay. Everything looks good. Okay. Say we go ahead and get this thing rolling. Oh gosh, the cat's gonna hit the camera. Dang it. Okay. Of course, the cats are just going crazy right when I start to stream. Okay. All right. Let's do this. Okay. If anybody is having trouble hearing me or if the stream quality is bad, let me know in the comments, please. Otherwise, we're going to get this show on the road. Okay. All right. As a value investor, there are thousands of companies that I could look at, that I could research. And so one of the most important things that is going to make me successful as a value investor, as a stock picker, is the ability to efficiently research companies. I don't have time to do due diligence on 20 different companies every week. I don't have that kind of time. So the screener that I use is so important. And there's a few different screeners that I've experimented with. This one on Morningstar is by far the best screener that I've ever used for honing in quickly on a company that is very likely to pass my due diligence test. And oh my gosh, sorry, I'm getting distracted by my cats. They are just running wild right now. I don't know if y'all can see them on the camera, but okay. So the screener that I'm looking at is Morningstar. And there are just a few filters that I use. Number one, we are filtering by the Morningstar rating. So I just have it displaying. A 5-star rating means that it is very likely to be undervalued. Morningstar sees it as incredibly undervalued. Now, that doesn't mean it's going to pass my test every time, but it is very likely to. If it has a Q next to it, that means a human did not create the rating. It was done by an algorithm. So if it has a Q, it's a lot less reliable. So that is a huge deal right there. Of course, I'm filtering by basic materials because I realized I need more basic materials companies in my portfolio. I had a little bit of a hole there, not enough exposure to basic materials. But the big filters here that I'm also including are a moat. Now, I always start with the wide moat. And if so I started with the wide moat. I went through all of the companies on here. None of them passed my value test. So I narrowed the search to now only to look at narrow moats. Went through this list and found one company that was incredibly undervalued. Now, I also have the screener filter by exemplary and standard capital allocation. So I don't want balance sheets that are way out of whack with massive amounts of debt. So I guess what the point that I'm making here is that Morningstar analysts go to the trouble to analyze companies. They have maybe thousands of analysts, maybe hundreds of analysts that work for Morningstar. I don't know how many, but so many. And they spend a lot of time and a lot of effort figuring out if companies have a moat and if they have a good capital allocation. And so that amount of effort is already baked into this screener. And I absolutely love that because it saves me so much time as I am doing my own value checks. So in this case, we filtered by basic materials. I've got it narrowed down to narrow moat, good capital allocation. The company that I landed on after going through all of these is Lindell Basel Industries. I don't know if I said that right. 5 stars on Morningstar. So let me go to the actual analyst report right here. So as we can see here, so this black line, this is the fair share price according to the analysts. The fair share price has been dropping lately, but the stock price, this price down here, has been dropping much faster, and it is now shown to be 5 stars. So we're going to get into that. So first of all, I like to read through the Morningstar analyst report. They put tons of good information in here. They sum it all up very nicely at the very top. So Lindell Basel's third quarter earnings continue to exhibit a global slowdown in commodity chemicals as profits were down versus the prior year. So, and it just occurred to me, we should read a description of what this company does before we get too deep into the weeds on this report. So Lindell Basel Industries. So this is the 5-year chart. We can see that they're down 41% over the last 5 years. So this company's been going down quite a bit. If we go to the about section right here, this is a chemical company in the US, Germany, Mexico, Italy, Poland, France, Japan, China, Netherlands, and internationally. The company operates 6 segments: olefins, polyolefins in the Americas, in Europe, polymer solutions, refining, and technology. It produces and markets olefins and co-products such as ethylene, aromatics, propylene, butadiene, and I'm going to stop embarrassing myself trying to say these words. So they do chemicals, all right? And as we saw in this analyst report, oops, this is not the analyst report. Here we go. That there is a global slowdown in commodity chemicals. So this is a cyclical company. They are at the mercy of the global market. And so as the global market goes up and down, it has highs and lows. As demand drops, this company sees a drop in share price. Because what do people see when they look at this company? They see revenue dropping, they see profits dropping, and the knee-jerk reaction is that this company isn't doing well, even though they're in a cyclical market. So the goal here is to catch these cyclical companies in an overreaction as demand is slowing, as business is slowing, catch them in an underreaction, and then as they ramp back up, as the cyclical market inevitably turns around, or we hope it'll turn around, then that is where we capture all of our returns. So the question is, how do we evaluate this company and make sure that it is indeed undervalued, that it's not actually dying, and that it's not actually, maybe it was overvalued before, and now that it's dropped, maybe now it's fair valued. So these are all the questions that we need to answer before we invest in this company. So number one, let's go through this analyst report very quickly. So why it matters: Lindell is looking to reduce capital expenditures and operating costs to support free cash flow generation while demand is at cyclically low levels. However, the company's results will ultimately be determined by the chemicals supply and demand balance. So free cash flow generation. This is the metric that I pay attention to as a value investor. Free cash flow is the chunk of money that companies basically return to shareholders. They use their free cash flow to pay dividends. They use it to do share buybacks. They also use it to grow their business, to create more free cash flow in the future so that they can return more money to me ultimately. So free cash flow is what I am paying attention to. I like it more than profit because profit can be reduced by things on paper. Now, that doesn't mean that on-paper losses don't matter or that they're not real, but I like to pay more attention to what is the company actually generating in terms of cash flow, and then how are they using their free cash flow. So, okay, To support the market returning to balance, Lindell is running its plants at lower capacity utilization, which is weighing on profits in the near term. We expect this will continue into at least the first half of 2026, as we expect the chemicals market will remain oversupplied in the near term. Roughly 10% of global supply has been announced for shutdown or anticipated through 2026. Yet we see supply growth in China offsetting much of the supply shutdowns as demand stabilizes in the second half of 2026. So according to Morningstar, they see a $90 fair value estimate for the narrow moat Lindell Basel as our outlook. It is generally or largely unchanged. So Morningstar says $90 is their fair share price. That's a good sign for me as I'm looking at this company. It means that I'm more likely to, as I do my own due diligence, come to a similar result. So they put the current share price is 50. They put the fair share price at 90, which represents quite the upside. Okay. So the next thing that I want to do is I want to see what is their actual revenue projections, because when I'm looking to project future free cash flow, I look at two different components. I look at the future projected revenues and I look at their historic free cash flow margin, and then I make some adjustments to the free cash flow margin as I make, because ultimately a value company it's not just about looking at what the company's done, how it's cheap now compared to its current profits. Ultimately, a value company has to be cheap compared to what it's projected to do in the future. The markets are forward looking. I'm forward looking. I want to see growth. And that's one of the best things about finding a value company, is one that is projected to grow would be ideal. So, okay. Free cash flow. What does their future revenue look like? If I scroll down to the bottom here, Morningstar gives their projections for revenue growth all the way down here. All right. Revenue growth percentage over the next 5 years. So 2025, they are projecting it to be pretty rough. 29% reduction in revenue. So if I go back to stockanalysis.com and I go to their financials really quick, we can see on the quarterly view that they've just completed 3 quarters in 2025. So even though we're in 2026, they're still working on their 4th quarter in 2025, which will end in March. So at the end of March. So that's what we're looking at. So in total, they're saying 29%. And we can see that in Q1 of 2021, it was 7.5% lower. In Q2, it was 12% lower than a year prior, and then 10% lower. So this company has been dropping in revenue, and this trend has been going on for quite some time. Like since 2020, each quarter has been substantially lower than the quarter previous. So that is important to note. Okay, back to the report. We are seeing the turnaround start in 2026, which was what we read, losing 4.7% in 2026, and then gaining 1% in 2027, gaining 3% in 2028, and then gaining 3% roughly in 2029, for an average over the next 5 years, losing 6.5% roughly. Okay, so there is my revenue component. I'm going to be assuming 6% losses in revenue over the next 5 years. And then to get additional confidence in my revenue projections, I also like to go to stockanalysis.com and go to the forecast tab, where they give me a bunch of analyst projections. So if we look for 2025, there was 21 analysts, 20 for 2026, 16, 4, and 2. So not a ton of analysts are weighing in on 2028 and 2029, but nonetheless, I have 5 years of projections aggregated from different analysts on stockanalysis.com. So I have a low, an average, and a high. So I'm also going to be pasting in this information into my spreadsheet so that I have a range of possible outcomes. So I'm not just honing in on one potential situation outlined by Morningstar. I'm looking at an aggregate of analyst opinions. So let's go over to the spreadsheet now. This is my automated free cash flow valuation spreadsheet. I use the discounted future free cash flow model. All I have to do is type in the ticker, and then on my data entry tab, it automatically pulls in all of the relevant data from stockanalysis.com. On my data formatting tab, it formats it into a nice organized spreadsheet where I can easily take that information and do the calculations on this tab. And then finally, it spits it all out on my dashboard. So I type in the ticker. Like I said, all of that stuff happens automatically. These are where I enter in my assumptions. So the first assumption we talked about is the revenue growth over the next 5 years. I have it at -6. For years 6 through 10, It's hard to find analyst projections for 10 years out. Sometimes Morningstar will give me projections for the decade. Let me just check. Decade. It does not look like. We forecast annual top line growth will average in the low single digits from 2026 through 2029. We forecast adjusted EBITDA margins will fall to the 10% range in 2025, but then we expand back to the mid-teens in our mid-cycle forecast, which is in line with the average of the past decade. So they don't really talk about revenue projections, but they do talk about their profitability over the next. So they're saying they're going to return to their regular profitability is what I'm reading here. So that is important to know. We're going to take that into account when we do our free cash flow margin projections. So, okay, let me go back to my spreadsheet. So 2%. So I'm basically putting this as of the low end of inflation, right? I'm thinking that revenue of materials and commodities generally stays with inflation. So I'm saying for years 6 through 10, 2% revenue growth on average. And then for the perpetual growth rate, 2%. So this is our revenue growth forecast. I've also entered in the analyst aggregate projections from stockanalysis.com. The next assumption is my discount rate. This is the minimum return that I want to see out of this investment perpetually. So I want at least an 8.35% return on investment. And then the final two assumptions here are the initial free cash flow margin, and then any free cash flow margin growth. So currently I have built in a 9% free cash flow margin. The average over the past 5 years is 7.85%, but this average does not take into account all the factors that I like to take into account. So if we go to stockanalysis.com, we go to their financials on their cash flow statement, the way free cash flow is generally calculated is they take the operating cash flow and then they subtract all of capital expenditures. Now, there are a couple additional steps that I like to take. First of all, if they have stock-based compensation, I subtract the stock-based compensation out of the operating cash flow. Generally, that doesn't happen. They don't do that. However, I like to count it against, because if we scroll down a bit lower to the investing cash flow, we can see that they do spend money buying stock back. So they're giving out stock, which is not reducing their cash flow, but then they're turning around and they're buying it back. So this is paying employees in extra steps, is the way I view it. So I do count free cash flow against. I also don't like to count 100% of capital expenditures against. I like to try to separate out what chunk of money is being used for growth and what chunk is being used to maintain their current property, plant, and equipment. So those are the adjustments that I make. Where do we make those? Let me scroll down. So right here. So I've actually got 4 different things that I will adjust for. Sometimes I will also adjust for R&D if I feel that they are spending money on R&D that is going towards growth. In this case, I am assuming 0 on R&D. For capital expenditures, I am assuming that 30% of their CapEx spending goes towards growth. Now, one way that you can approximate this without doing a bunch of research is you can compare their capital expenditure spending to their depreciation. In a lot of cases, depreciation is roughly equal to the maintenance spending of CapEx. In this case, depreciation is 1.2 billion, whereas CapEx is 1.9. This is roughly 30%. So in my initial assumption, I put 30% in here as growth, and then I verified it by doing some research. Let's see, where did I find that? I found it somewhere. Bear with me. Where did we see that? I found it in one of these slides, and it was 70 to 75% was maintenance. I just can't remember where I saw that now. Maintenance. Of course, I cannot remember where I saw that. Anyway, I will remember at some point. For now, take my word for it. They spend roughly 25 to 30% of their capital expenditures on on growth. So that's where we have the growth. I count 95 against on stock-based compensation. For acquisitions, if they are performing a lot of big acquisitions that are not synergistic with their business, then I will count acquisitions against, because I want to see revenue growth, but not just, I don't want low quality revenue growth. And if a company is just acquiring, businesses that don't synergize well with their current business, and they're bringing on revenue that doesn't have like the same margins perhaps, then I don't like to count acquisitions towards the free cash flow, because if it doesn't have a meaningful result on future free cash flow. In this case, they don't have any acquisitions over the past 5 years, so that does not affect the free cash flow margin. So given those adjustments, I have now 9% as my new average free cash flow margin. So we are putting that in the cell. And that's over the last 5 years, where through 2022 has been it's the industry cyclical. It has been the low side of the cycle. So in my mind, this is taking into account a huge percentage of the years I'm looking at to generate this average is during a low cycle. So I think this is a conservative free cash flow margin. So given a 9% free cash flow margin, no free cash flow margin growth, even though the Morningstar analysts believe that they will be returning to past free cash flow margin, my projection here, wouldn't you know it, basically $90, almost perfectly in line with the Morningstar analyst opinion. So maybe this is what they're coming up with. Maybe they're doing a similar valuation model. I wouldn't know, but I'm calculating 90%, which gives me a 78% upside on the stock. 78%. That is on top of the 8.35% minimum return that I want to see every single year. So, and just to show you how this works, if I say I want a 10% minimum return, oh, okay, perfect. Now you can see that my projection now reduced to 30%. So now there's only a 30% margin of safety if I want a 10% return every year. Now, I like to stick to 8.35, the discount rate of 8.35. Where did I come up with that? I get that by putting in the current risk-free rate, which is a 10-year U.S. Treasury. You can get that return virtually risk-free. It's a little over 4%. And then the current equity risk premium is also a little bit over 4%. This is the additional return that you should want when you're investing in securities, because it's not risk-free and it fluctuates over time. Depending on what source you look at, you're going to get different results, but this is the one that I go with. So a minimum of an 8.35% return, and I want to see a large margin of safety. Now, these projections right here, these analyst high, average, and low, this is using the average or the high, average, and low projections from stockanalysis.com. So if over the next 5 years, this is the spread of possible outcomes, then in the worst case scenario, I am losing 16% of my 8.35% return. So I'm not getting the full 8.35% per year. I'm buying the stock price 16% too high. If the average analyst is correct, then I have the 67% margin of safety. And if the highest analysts are correct, then I have a 200% margin of safety. So given this spread, given this margin of safety and the spread of analyst opinions, I think that the risk reward ratio is looking very, very good for this company. So the next thing that I like to look at is a little bit more qualitative research. So I like to go to their most recent quarterly report, read through some of their slides, go to their most recent Q&A session and read about what is the management saying that they're going to do, what is their plan to weather the storm of a low cycle moment. So let's look at some of the highlights of what I found really quick. So, and also before I do that, I also want to point out, if I go to the overview on this company, they currently have almost an 11% dividend, which is incredibly high. So I also want to evaluate, is this dividend safe? Because whenever I find a super undervalued company, I do like to see a big dividend. So, the dividend, it's just one component of the free cash flow. So technically, like in a vacuum, the dividend doesn't matter. It's just one piece of how they're using their free cash flow. And they could be using their free cash flow in many good ways. For instance, if if I go back to the financials and look at how they're using their free cash flow, we can see that they had, in the trailing 12 months, they had $2.6 billion come in from operations. They spent $2 billion on CapEx, of which roughly 30% was geared towards growth. They also spent, let's see if I scroll down a bit further, they spent $280 million buying back stock, and they spent $1.7 billion paying dividends. So the majority of this company's free cash flow is going into these two categories right here. They're spending some on growth CapEx. That's true. What is that? That might be $600 million in this case. Somewhere between $400 and $600 million on growth CapEx, but the bulk of it is on share repurchase and dividends. So that's what this company is doing. But we could also see more on CapEx. We could see them start to spend more on research and development. For instance, there's other ways they could be acquiring companies that do have a very strong synergistic effect. I'm not necessarily biased towards the dividend, but in this case, because the company has dropped so much, as long as they have the free cash flow, available to continue paying their dividend, in my mind, this sets a floor to what the share price can fall. If they truly are making the money to pay the dividend, if the share price falls, then the dividend percentage keeps going up. It becomes 15% and then 20%. And when shareholders see such a juicy dividend, people just can't resist. They have to buy it. So in my mind, psychologically speaking, it creates a floor on the share price. And I think it makes it less likely to drop further unless this company can no longer support this dividend. That is the kicker. Can they support the dividend? So if I go back to the financials, well, let me go to the dividends page really quick, just to show that they have not dropped their dividend in maybe ever. I need to look. So currently they're paying $1.37 per share, per quarter. Then they were paying, if we go back a year, they were paying 1.34, 1.25, 1.9. They had a special dividend where I guess they made a whole bunch of money this quarter. They paid out $6 per share. So it would have been nice to be a shareholder then. But as I scroll down, you can see the dividend, they've been increasing their dividend over time, going all the way back to 2016. So over the last 10 years, and here's the graph view. Can we look further? No, that just gives me 10 years. So they've been increasing their dividends slowly over time. So as long as they're able to keep increasing that dividend, as long as their business is strong, it's going to be difficult for shareholders to pass up on such an increasing dividend percentage. So, okay, can they sustain the dividend? The first thing to look at is, what do they need to pay over a year? Roughly, Roughly $1.7 billion. How much cash do they have on hand? They currently have $1.7 billion in cash on hand. So at least in the short term, at least over the next quarter, they can probably pay their dividend. In terms of cash flow, though, this is where they could get into trouble. If their operating cash flow minus their capital expenditures starts to drop, if their free cash flow starts to drop below the 1.7 billion mark, then at that point, we could see some issue. So that is what we need to be looking out for. Stockanalysis.com shows their free cash flow at $738 million. And again, I believe that's too low because they're not giving them credit for about $600 million worth of growth CapEx. And, they're not going to be spending it all on growth CapEx. How do I know that? Let's get to some of the qualitative research. So in their most recent Q&A session, that's what I want to look at now. Okay, here we go. Wait, no, sorry. Q&A session right here. Okay. Let me go to some one of the analysts asks a question about the dividend. So let's go to dividend really quick. Okay. Matthew Blair says, "Great, thank you. Good morning. Can you talk a little bit about the security of the dividends? I think the current yield is up to 12. So at the time of this was October 31st. It was even higher. And despite the strong cash conversion this year, your free cash flow appears pretty unlikely to cover the dividends. So how are you thinking about this? And, with the cash that you spent on the dividend, would that be better served in areas like shoring up the balance sheet or maintenance CapEx or things like that?" That's what he's asking. Okay. So how does management address this concern of free cash flow, and can they cover the dividend? Thank you, Matthew. And of course, we are expecting that somebody would ask this question, Thank you for the question. Let me highlight 4 points on our thoughts about the dividends. First of all, as you know, we are very careful in how we are managing our cash during the last couple of years. And I know some people have asked us questions why we are keeping that cushion. Today, I'm happy we did those decisions in the past. So number one, he's talking about his cash cushion. We looked at that. They had $1.7 billion in cash. So in the near term, they're covered. But he still has not responded to the long-term question yet. Okay. 2025, we had a cash balance that provides us with a cushion. It's a robust balance of $3.4 billion, which has been much higher than the cash balance than we had in the past, around 1.6 to 1.7. So in the past, they had a much higher cushion. It has been dwindling since this interview. That's the first point. So they're saying their cash cushion is the first point. The second point, we continue to take a balanced approach to capital allocation, especially as we are having the cycle. We remind you again, we are on track. The cash improvement plan, $1.1 billion at least until the end of 2026. So they are on a cash improvement plan. The first tranche of $600 million until the end of 2025, we set well on track. And we also communicated today, we looked into more detail on our CapEx. Okay, so as a part of this cash improvement plan, they are looking at CapEx. We would further reduce our capital expenditures from $1.4 billion to $1.2 billion again in 2026. So they're saying for the year 2026, 1.2. So if we compare that to previous years, we saw CapEx was 1.9 over the trailing 12 months. So for 2026, there's basically $700 million that's going to be greater in terms of free cash flow because they are not spending near as much on capital expenditures. And maybe they're going to be cutting back on some of the gross initiatives. So maybe the capital expenditures, maybe the free cash flow isn't technically changing. They're just moving some of the growth CapEx to dividend CapEx. But as we're going to keep reading, the maintenance CapEx will also be changing a little bit. So the third point, our investment grade balance sheets remain, of course. Am I reading that right? The third point is our investment grade balance sheets remains. Okay. What he's saying here is that they can get cash because they have such a strong balance sheet. They can get loans very cheaply. So if they do have cash troubles, they can get loans. You all know that investment grade makes it cheaper to do business, avoids having to make dramatic changes to our strategy or portfolio to address the balance sheet. Okay. And we continue to have very proactive dialogues with credit agencies. So they're talking about, their revolving credit line. We are also fully aware of their expectations and sensitivities. So also as part, you saw our actions of navigating the cycle. We proactively negotiated the net debt to EBITDA covenants on our RCF in September from 3.5 to 4.5. So they are able to have a greater percentage of debt is what they're saying there through 2027. Okay. So the first point is that they are spending less on CapEx. The first point was that they have a big cash cushion. The second one is that they are going to be spending less on CapEx. The third point is that we can get loans. The fourth point, and the last point I want to make, is safe and reliable operations. Now, sustaining CapEx remains a core priority for us. So we're not shortcutting, we're not putting safety and reliability in jeopardy. But as we have transformed already our portfolio, it means also that moving forward, we can do less safety and reliability. So what he's saying here, sustaining CapEx is what he's saying. So he said that their CapEx has been high in the past because they have made investments into improving safety and reliability. And going forward, now that they've made those improvements, they get to benefit from them going forward. They don't have to continue investing as much into those improvements. So their sustaining CapEx will now reduce. That's what he's saying. And that, and that is the exit of the four sides. Okay, so those are the 4 points that he's making pretty much. They are very committed, so therefore we continue to believe that we will be able to close the first half of 2026. And of course, we will continue to free up CapEx for LYB. Thank you. Okay, so that's what he's saying. In my mind, it's a decent answer. It's not the best answer. He didn't come out and explicitly say that we are not going to have any problems with the dividend. He didn't say that. He listed a bunch of things that they are doing to make it more likely. But the dividend could be a problem. They may have to reduce the dividend. So that is a legitimate risk with this company, because if they do cut the dividend, I believe the stock price will drop quite a bit. Now, just because they cut the dividend doesn't mean that their free cash flow is reducing. However, it is a red flag. It doesn't necessarily mean that something bad is happening, but it could be. So we'll have to take that into account. Now, given that this company is not without its risks, it does appear to be incredibly undervalued, but there are legitimate risks here. This company will be a small percentage of my public YouTube portfolio. I like to take a highly diversified approach. In my public YouTube portfolio, I have over 40 companies. So any one company represents a very small percentage. And so the plan is to make as many undervalued purchases as possible that all seem incredibly likely to make good returns. And that way, inevitably, when a few companies don't do well, the bulk will continue to push the returns of the portfolio up. So that's the goal. That's the hope, we'll say, with this company, is that it seems to be incredibly cheap, but it's not without its risks. So it's taking up a very small percentage of the portfolio. Another thing I wanted to look at, risk factors. Okay, I skipped a little bit of a step here. This is on their most recent annual report, I believe. It's always good to go to the risk factors. They're required to spell out all of the major risks that they see with the company. And the number one risk here is the cyclicality and volatility of the industries in which we participate may cause significant fluctuations in our operating results. So they spell it out right here. This is a highly cyclical industry. They're up and they're down. We're trying to catch the market at an overreaction point. And we can be confident as we reasonably can, that it is overreacting because given the analyst projections, and the analysts are projecting that they're going down. I mean, we're seeing on average 25% drop in revenue in 2025 and then 1% drop in revenue in 2026. So it's not like the analysts have these high expectations. No, the analysts are projecting losses here, and we're building those losses into our spreadsheet, and we're still seeing a 78% cushion. So that is how I'm confident that this company has a strong likelihood to outperform the market, because it is underpriced compared to its projected future free cash flow, given conservative assumptions. That is the whole strategy that I implement. Is I try to find companies that give me a significant margin of safety. And so now let's go to the public YouTube portfolio spreadsheet, the public YouTube portfolio, and let's check out our performance. So give me one moment here while I pull it up. Got to log back in here. Okay. All right, here is our performance on the public YouTube portfolio. So we were outperforming the market nicely, but as you can see, in the last couple days, our portfolio has dropped and the S&P 500 has risen. So not good. 16% is the SPY over the last year. We're at 17.25. The portfolio is just a little bit over a year old. Let's look at what's going on with the portfolio. Why have we had a little bit of a dip here in the short term? So I've got my portfolio divided up by all the different sectors. And as you can see, materials is down 3%. We're down 5.5% on finance. We're basically flat on healthcare. It is consumer discretionary, bleeding red. Every company that I have in this sector is down. The big ones being Lululemon, Trip.com, and this is I'm drawing a blank, the Chinese company, the Chinese Amazon, drawing a blank, not Temu. What? Wait, maybe it is Temu. I'm drawing a blank now. Let's go to stock analysis. Got to pull it up. The Chinese companies are having trouble. Is it Temu? It is Temu. Sorry. Yeah, Temu. Okay. And I have not done research on these companies yet, so that will be a discussion for a future episode. I need to do some research. What is going on in China? Oh, hey, Hokage. Sorry, I just saw your message. I don't know how long that message has been there. Sorry, man. But yeah, it is Temu online shopping. You're right, 100%. So yeah, if we go to the monthly view, yeah, they're down 10% on the month. I mean, they're just down considerably lately. It looks like we bought maybe at one of these high points, and they've been dropping. So the recent shift in the portfolio is due to that one. Lululemon has also dropped in the near term. So this is another company that I need to research to see what is going on in the last month, 13%. There was one more. Oh yeah, Trip.com, same deal. And then let's see. What else is doing bad in the short term? I believe we were up in healthcare, and then yeah, gosh, it's earnings season, so there are a lot of big moves. UNH, we are down on UNH. And I should also point out, and HIMS. Okay, so I should also point out that in January 1st or 2nd, we did a portfolio reset. So these are not showing our total returns on the holding. This is showing our return since January. These are showing very short-term returns. It is unfortunate that it reset my returns on a lot of these companies. I didn't set up my portfolio well enough by sector. I didn't have it organized nicely, but now that we have it organized, hopefully we're not going to have to do like a massive rebalance like that again, where I have to shift a bunch of things around. So hopefully that won't be a problem going forward. But yeah, so these are very short-term returns. So UNH also has gone down a lot lately. But today it's up 4%. But yeah, see, we can see here in the last year. Oh, and right here, that would be it. Sorry. Boom, right there. Big drop. So anyway, we've definitely got some companies we need to look at to see, did they have material changes with their business, or is this a short-term drop in revenue, a short-term drop in earnings that is not going to be repeated, where the company is going to likely recover going forward, in which case, I don't need to sell out necessarily. So the only reason I would exit a position on this portfolio is if I run this discounted free cash flow calculation, and then the result is that the company is no longer undervalued. As long as I'm projecting the company to be undervalued, I'm not going to react. I'm not going to overreact if the stock price drops. I'm going to try to take into account future earnings and future revenue as much as possible as more information comes out. And if the future prospects of the company change, then we sell. Okay. HCA, ASML, Meta, Minias are doing big moves. UNH, I missed the boat. Maybe I can buy it soon. Also, some of the small caps, UAN, World, GAM are down too. So let's look at some of the small caps. I did see World, and that's one that I also, like I said, I haven't had a chance to look into any of these that have dropped recently. So that is one that I'm also curious to look at. Okay, so like I said, the portfolio is divided up by sector, but I do have one category here for small cap, low volume stocks. This is kind of my pet group of companies that are a little bit higher risk, a little bit higher reward, because they're very small and they have very low trading volume, which means it's very easy to push them around. They could have very volatile price movements. And as we can see, World has had a very volatile price movement. So depending on what's happened with this company, this could be a really great time to buy, because it doesn't take many people selling to have a huge impact on the share price. So it just takes one big shareholder who maybe they just want to sell because they had something come up in their life, like they have to buy a new house. Like, who knows what the reason is? Who knows if maybe just a few people overreacted, or maybe they just don't want to hold it for whatever reason. It could be a good reason, could be a bad reason, but the share price is going to react in a big way. So in this case, 18%. So this is actually one that I'm really curious to look into right now, actually. So what happened with this company? Financials. Let's look at the quarterly. Did they just recently have a quarterly report? December 31st. That can't be it, right? Because they dropped in January. One day ago, earnings call transcript. Okay, so it just hasn't made it onto, wait, Q3? Did I have a brain fart? Quarterly, Q3. Okay, I guess this is it. So the period ended, I'm sorry. The period ended December 31st, but they reported it, I guess, a day ago. Interesting. So their revenue is flat. Their profit, net income, they had negative net income. So they didn't make money, but in terms of cash flow, oh, and of course the cash flow is not, they haven't made it on to stockanalysis.com yet. So anyway, I think this one could be an interesting one to look into. Okage says also HCA, ASML. Gamb was one that we were not able to invest in on the channel because M1 Finance did not support it. So unfortunately, that one could not make the cut. But let's look at it really quick. I'm curious. This one was a gamble. It is gambling.com. And this one was a risky, this was a high risk, high reward one. 9% down. Yeah. Oh, in the last year. So it's just been dropping for the last year. Oh man, is it low? This one, I believe, I want to say we were looking at it whenever it was around this range right in here initially, if I remember correctly, in August or October, maybe around here. And then it has since dropped even more. Can't remember for sure. Were we looking at it this late in November? Okage, do you remember when we were looking at Gamb? Okay. Healthcare. HCA. Wait, is that not healthcare? Was that one? Yeah, HCA Healthcare. GAN was around 6.7 when we looked at it. Oh, so it's dropped, so yeah, like 30% since we were initially looking. Yeah, so as a value investor, we are definitely going to have, especially in the short term, companies that do not work out, because we're not trying to time them at the very bottom. A lot of times we're buying companies that are going down or have gone down. We're not trying to have the best timing necessarily. It would be nice if we could time the market, but in general, I'm going for long-term return. So I'm trying to buy companies that are likely to outperform over many years, over like a 5-year period, let's say. I want to exceed 8.35%. I want to exceed that number with as big of a margin of safety as possible. So unfortunately, we're going to have misses from time to time. Oh, that's right. We sold out of HCA, didn't we, Okage? And of course, it went up a little bit after we sold. That's classic. Nailing the bottom and hitting the top is going to be almost always a miss. Yeah, you're right about that. I mean, 3% over the last month. I think we sold about a month ago, so yeah, we didn't hit the top. HCA may continue to go up, but HCA was one where I revisited it on my spreadsheet, and the margin of safety just was not there for me. So I went ahead and sold. ASML. Let's look at ASML. ASML over the last month. Oh, ASML's gone up quite a bit. Is that one that we sold? That's unfortunate. Yeah, ASML was sold. We missed on that one as well. They must have had a very good earnings report. That's the risk. Well, we'll keep an eye on it. Anyway. I believe all of these tickers will have a cool off period. BTI is doing very well. Also Meta. Meta is one. Oh, Meta is not in the tech sector. It is in the communication services sector. I believe we still have Meta, do we not? Communication services. Yeah, we still have Meta. Oh, thank goodness. We have one. We have one that did well. Wait, did it do well, or am I last month? Yeah, okay. Went up a bit. BTI. Oh yeah, BTI is up quite a bit as well, and still with a 5% dividend. BTI is in the consumer staples sector. I believe our consumer staples is doing well. It's our consumer discretionary that is not doing well. Oops. Here we go. Oh, that's communication services, dang it. Consumer staples. Yep, and we'd still have BTI. Yes. In any case, so the company that I'm investing in this week is LYB. Yeah, I guess tobacco is a staple. I mean, if you are addicted to it, you have to continue to buy it no matter what the economy is doing. So I guess that's why tobacco is a staple. You have to keep buying it. Now, it probably will be, I want to say it's probably in the long term going to be on the decline as young people are less likely to smoke, but you never know. You need it for nor'easter cold. I don't know what that is. Nor'easter cold. So every week, I like to buy $200 worth of a new company. This week, the new company is LYB. I also like to put $50 into an existing company that I see as significantly undervalued, that has moved down in price since we initially bought, and that we want to put a little bit more into. So what was I doing in the small cap over the last couple weeks? I had been putting $50 into Nexen, and it has recovered quite a bit. So that worked out. Nexen. It was down here when we started putting more money in, and it has climbed back up. So this week, cannot use Nexen. I believe it was Nexen. World is the one I would like to put more money into, but I need to do some research before we do that. WRLD. So this company has historically had a very high free cash flow margin. Let's do a quick analysis. Free cash flow margin on this company, on average, over the last 5 years, taking away all stock-based compensation, not giving any credit for R&D, CapEx, mergers, no credit, we get 44%. So if we assume the same percentage going forward, and we assume 0% revenue growth forever, perpetually, then the cushion is huge. That's what's crazy about this company. It appears to be so undervalued. I think this company just gets pushed around so much because it is so small. It is so small. Market cap $550 million. This is a micro cap company. Very low trading volume. 125 shares sold. 125,000, 126,000. If we go to the forecast page, there are not too many analyst projections. There are 4 analysts aggregated here that give projections over the next 3 years. So all I can do is just take those analyst projections, paste them into the spreadsheet, make my own projections going forward. So we'll just say 5 and 5 because I got to have 5 years of projections. We'll copy the low one there. Or you know what? We'll make it 0 and 0, and then we'll say for the low -2, -2. So we'll use this as our 5 years of analyst projections, even though I've kind of just made up these last 2 years. And yeah, given that spread, it's just still such a huge margin of safety. I'm not having the wrong currency, am I? Yeah, it's in USD. I mean, this company is just a cash flow machine, and yet it is so low in share price. How are they spending their free cash flow? So they had in 2025, they had 90 million in net income. They had to write off a lot of bad debt. So this company is a credit company. They give credit to people who have a hard time getting credit. So that's where their business model is pretty risky. But they have write-offs for bad debt every year. They have every year positive operating free cash flow, right? So 10 years ago, they had 200 million in operating cash flow. 10 years later, they have 254 million. So they really don't grow. They kind of stay flat. They stay stagnant. So they're not really growing. That's why I'm assuming 0% growth for the next 10 years. They don't spend much on CapEx. They have some cash acquisitions. How do they spend their debt? Or sorry, how do they spend their cash? So they have been paying back debt. So 50 million, they paid back debt, and then they repurchased 56 million in stock. So they basically use their free cash flow to pay back debt and to buy back stock. That's what they've been doing in terms of stock-based compensation. They did have a lot of stock-based compensation, oh wait, this is negative. Is that a negative number? I actually need to look into that. That's strange. So normally stock-based compensation is a positive number because it's increasing their cash flow. But in this case, it's negative. So I guess I don't know. I don't know why it would be negative. They declined shares and spent cash. I don't know. That's strange. I'll have to look into this, why that's a negative number here. See, as we go back, it's always positive, except, well, here it was negative. But anyway, so that's how they're spending their cash. They're having significant free cash flow. On the ratios tab, their price to book is very low. I'd like to see it less than 1, but 1.5 is incredibly low. Their free cash flow yield. So look at this, 36%. So generally, a free cash flow yield of 10% is considered really good. Like compared to the share price, like what's the equation on this? Free cash flow yield. Free cash flow yield is the free cash flow divided by the market cap. So the or you could also look at it like free cash flow per share divided by share price. 36% in 2025. I mean, that is a massive free cash flow yield. I mean, this company just creates so much free cash flow, and they are buying back tons of shares. So 8% of their shares they bought back in over the trailing 12 months. 8%. That's like equivalent to it. That's basically an 8% dividend. And they're buying back their shares while the company is so low in share price. So over the last year, it's been quite low. So yeah, I think this is going to be the company. I'm going to tentatively say that I'm going to be putting my $50 of buying an existing company into this company right here. I'll do a little bit more research off camera and read through. I'd have to read through their Q&A session. I don't want to do that on stream. I feel like that'd be kind of boring. I got to read through the Q&A. I got to look through their most recent quarterly report and just see if there's any like massive red flags that would account for just having such a huge discount. You know, it could be that when I go to their Q&A, the CEO is like, well, we're going out of business, y'all. You know, this has been a tough time, but we're going out of business. You know, there could be something really bad in there. So before I commit 100%, I'll do some research off stream, and then for the next stream, I'll touch base on what the decision was. But tentatively, it looks like it's going to be World Acceptance Corporation is where we're going to be putting our money. Yeah, that's all I got. Hokage, it could be an error on stock analysis. Yeah, it could be. I'm not sure what's going on. It needs a little bit more research. It looks too good to be true on the spreadsheet. It looks too good. 300% margin of safety. Like, oh my gosh, that's crazy. It's crazy. We got to look into it. Anyway, that's all I got. If y'all have any companies you want me to look at on stream to do a quick and dirty discounted free cash flow analysis with some, just some surface level assumptions. Not going to do a deep dive on stream, but we can do an initial look. If anybody has any companies they want me to look at, let me know in the comments, and I will potentially feature it in an upcoming stream or video if it looks to be really undervalued. Hokage pointed out a few in a comment on my last video that I still need to address. So Hokage, you had a couple. What were they? They were healthcare companies that looked incredibly undervalued. I have those on my list of companies to look at. So those, if they pass the test, they may be featured on the next video that I do this weekend. So anyway, just so you know, I appreciate you tuning in, Hokage, and giving me some companies to look at. And yeah, if you have any more, let me know. Otherwise, good night. And I hope to see you next time. Oh, yeah, there it is. MOH and OSCR. I believe those were the two that looked the best. MOH. Yes, MOH was one. OSCR. What was this? Yep, those two. Those are the ones. Okay, anyway, good night. Hokage, thanks for tuning in. I appreciate you, buddy. And everybody else who's watching, I hope to see you next time. Cheers.